Hello, and welcome back, guys. We're going to talk about a company which I find rather interesting here. It's called Veeva Systems, and it's not a very well known one. It's sort of like a CRM company operating in the healthcare sector. But let's take a little bit of a look at our company analysis page here in the company profile just to see a quick description. This provides a cloud-based software. It's a software service for the life sciences industry in multiple regions. They offer commercial cloud, a suite of software, data, and analytics solutions, Veeva customer relationship management, Veeva medical CRM, and so on and so forth. So it is a company that is a relatively new company. It's not a very old one. 2013 was the IPO, and it has been going down a lot. It's a company that you can kind of think of it sort of like Salesforce, similar to Salesforce, although they are operating in different industries pretty much. But the idea is similar. Now, this company has been down about 52% from its 1 year high, and it's very interesting to see. And it could be a potentially great buy for holding for many years, a long-term hold. Now, if we take it back to the 5 year chart, you will see the downtrend over here. Again, all of these companies, the majority of companies pretty much in the US have been doing badly in the past few years. The market has been tanking, has been crashing pretty much. And so this is no exception. Today it's up 4%, but overall down 52%. It may be an interesting opportunity. As usual, we're going to examine the financials though, because we need to know what is happening with the company and whether it's a nice buy right now. Now, the PE ratio of the company is still high. You can understand that it was much higher when the company stock price was double. It was effectively almost double. And the price to free cash flow is a little bit better here, but still 32. Now, this is a software company. It could be okay to pay a little bit more, but we need to see how much more. And of course, we will examine that using our stock evaluation tool. This is important. We're going to be doing it a little bit later. But first things first, outstanding shares have been going up a little bit. So the company has been issuing some shares. Now, lately, they have still been issuing shares, which is, I find it a little bit confusing because the company doesn't seem to be, the stock at least, doesn't seem to be too overpriced here. It may be slightly, but doesn't seem to be too overpriced. Now, we will examine that because I may be wrong, but just based on what we're looking here on the ratios. And so the fact that they still keep issuing shares, and even in the January 2022, that's a little bit weird to me. So January 2022, the stock price was at about, actually it was much higher, so it does make sense, 236. So it does make sense that they issued shares here. So people who bought here were actually kind of burnt. Okay, so the company's liabilities are very low, as you'll see. Pretty much the free cash flow is very easy for them to be paying back everything. And look at these metrics. I love these metrics. Revenue growth has been pretty much increasing year over year. And what about the net income growth? Same story. Free cash flows. And the same graph pretty much, sort of like an exponential type raise here. Very nice to see. And total equity growth has also been growing. And yeah, the company has been issuing some shares, but you will see that the company is very profitable and it's getting more and more profitable here. You can kind of see that from the net income. They were almost negative here and they started growing and growing. Very nice. Now, the net income margins are also fairly nice. Remember, this is a software company. They have been going down a little bit, which you would expect, but again, because of the economy right now, pretty much. But they're still pretty high, 20%, and I'm assuming that they will go even higher in the next few years. Now, the return on equity is 13%, rather typical, but the company doesn't have debt. As you'll see here, debt to equity ratio is basically zero. So the company has very little debt. In fact, it may be a good idea to get some. Now, in case of the net income, the case of the net income is the case of a company that has been growing it very nicely, almost threefold over here, from 700 million to 1.9 almost in terms of revenue, and everything in the green over here. I love to see that there's no red value here. It's all increasing and increasing is what this means pretty much, is the growth. And the net income, again, from 142, again, almost tripling it, 427 over here, if not more than tripling it actually. In case of in the sense of their balance sheet moving forward, you will see here that the company's total equity is almost 3 billion here. And the company has been issuing some shares, especially the past year or so. But the total liabilities are sitting at less than $1 billion. And if we take a look at their cash flow statement, you will see that they made 764 million in free cash flow last year. And so they can very easily pay that back. As we saw, it's about a year and a little bit more, which is amazing. The company is super solvent here, no troubles. So with debt or liabilities even, this is not even debt, it's the whole liabilities that the company has. And you will see here that the net income from 400 million becomes 700 in terms of free cash flow. Again, because we have the stock-based compensation, the well-known plague that happens in most tech companies, especially in the Bay Area, as Veeva is. And investing activities over here, minus 300 million, over, as you will see. And the company has been having some financing, very little here, just basically spending some money here to be paying back some debt, which is nice, the little debt that they had pretty much. And they have about 1.1 billion in cash. So it's a very nice company here, and they have been growing fairly nicely. And again, down 52%. Now let's take a little bit of a look at some other things about the company. I'm kind of curious to see what's happening with institutional holders lately, and this is the latest reports in June, pretty much. And you will see that a lot of companies have been adding this company price, like T. Rowe Price, for instance, Thomas Rowe, and Vanguard has also been adding it, Artisan Partners. Morgan Stanley has been actually selling out of Veeva quite a lot, quite substantially actually, 35%, which is frankly kind of weird. They had the 3.73% ownership after selling all these. They still have quite some though, but T. Rowe Price has the highest ownership, 10% of the company. That's a lot. Very interesting. And in terms of investors, that's institutional holders, pretty much aggregate data that the tool provides here, you will see that it has been increasing. The total ownership of the company has been increasing pretty much through the years, almost every year, especially the last 3 years, and it keeps happening. 123 million shares held by investors right now. Very interesting to see. In terms of insiders here, you will see that we don't have anything out of the ordinary, pretty much. Some selling here and some sales from pretty much awards and things of that sort. So I don't really see something out of the ordinary here. No weird sales. And as usual, we want to be taking a look at the chief financial officer, see how much they are selling, and their selling seems rather typical, very typical actually. So I don't see anything out of the ordinary here as well. Very normal stuff. Okay. So the other thing that we also want to be always taking a look at is the Senator trades, but not much happening here. This is like last year's sale, purchase actually that somebody did. That was in March 2021 though, so not much happening with Veeva over here, so not much in terms of Senators. But the last thing, and obviously very, very important, the stock evaluation tool. Now the company has been growing a ton, as you'll see. 27, 29, 26 last year. We're going to go lower because the company will be growing lower. There's going to be about 15% is what I saw from analysts. But I'm going to go even lower. I'm going to go 10, 12, and 14 here for our revenue growth. Net income margins have been suppressed lately, but I don't think this will happen for the next 5 years. They have been sitting at about 20% lately. Still, I'm going to go 21, 22, let's go in 23 here. And in terms of free cash flow margins, always more than 100%. That's probably due to stock-based compensation. But we will go more than 100 here. So we'll go 100 and 110 and 120. And annual return of 13% is what we are going to be asking for. This could even be higher in terms of free cash flow margin based on what I'm seeing. The average is actually 150. So we could go even higher here. But let's try these values first. And you will see that using this revenue growth and these margins pretty much over here, we are still in the red. So the high estimates are sitting at $80 almost, with the current price being at a very high 157. So we are far from where we would like it to be. And if I go with free cash flow margins that are a little bit closer to what the company is actually doing, so let's go a little bit higher, 130, 140, and 150 here, and we hit calculate, you will see that we are still sitting at about $100 for our high estimates here of 13% revenue growth. And if I go with what we expect to happen, like 15, 17, and 19, we don't really expect these. These are actually more aggressive. But even then, I'm getting a red. So with the current price of $157, while I like the company a lot, it is expensive, so I couldn't be adding it to my portfolio. I like what I'm seeing in terms of the business. Like, I like the business a lot, but I don't like the stock price. It's still expensive for what I would want it to be. It would have to be probably less than $100 for me to get interested in Veeva Systems. Although, again, it's a fantastic company. They have been growing very well as well. But I do want to be buying things in the cheap, and when I have the chance to buy something that is expensive, I really have to gauge the market and see whether there are better opportunities, cheaper opportunities of similar companies or even better companies that are doing well. And I will be having this one on my watch list. If it grows lower, if it goes near $100, then I think it would be a fantastic buy, frankly. And so if it heads there, I will be definitely making a new video and be telling you about this. But thank you for watching this one. Leave a like and subscribe, and I'll see you in the very next video, guys. Bye bye for now. See you soon.